Wednesday, April 12th was the main event of our week. MBS were up 8 basis points early this morning. Stocks were up 18 points. And the 10-year was pretty much flat. The importance of today's CPI report may have seemed overstated in its approach, but the market's reaction to the merely as expected core numbers showed that it could not have been overstated. 10-year yields had rallied an instant 9 basis points as soon as the news came out, perhaps the largest reaction for the past few decades for economic data that was right in line with expectations. So basically, the CPI number came in month over month, came up at 0.1 on a 0.2 forecast. It was 0.4 previously. Year over year CPI came in at 5 versus a 5.2 estimate. It was 5.5 previously, so picking up some extra room there. Core month over month CPI came in at 0.4 on a 0.4 estimate. It was 0.5 previously. Core year over year CPI came in at 5.6 on a 5.6 forecast. I saw some people forecasting 5.2. It was 5.5 previously. Unfortunately, heavy selling in the European Union and a looming Treasury supply environment are pushing back on the rally early. That said, the closer look at the CPI numbers provides hope for the coming months, although let's keep in mind that even though there is a bit of an improvement, these numbers are supposed to be 2 and 3 handles. There were a few highlights from the largely as expected Fed minutes released. Participants agreed actions taken by the Fed and others had helped calm the banking sector conditions. Participants commented that recent pre-meeting data indicated slower than expected progress on disinflation. Several participants noted that they considered whether it would be appropriate to leave rates unchanged. However, participants noted actions taken helped calm conditions and lowered near-term risk, allowing them to judge an increase as appropriate. Several participants noted wage growth is still well above rates consistent with 2% inflation target. So sounds like we haven't seen anything to indicate that they should keep increasing these. This morning's as expected inflation data was well received by the bond market. In other words, it resulted in a much bigger rally than the results would have indicated or suggested in and of themselves. It was short-lived in any event as bonds returned to unchanged midday. The 10-year auction pushed yields higher while the Fed minutes allowed for a recovery back to stronger territory. All of the above transpired in a fairly narrow range, especially relative to last week's market movers. So at the end of the day, we're up 22 basis points at 101.3. Stocks were down 17 points, and the 10-year Treasury was down 3. So at 101.3, it's going to put us down here right around this blue line that is trending downward, which is the 200-day moving average. So it's going to put us right around the 200-day moving average with 3 converging floors shortly below it. So that should provide a lot of stability there, and we'll have to see how the deeper dive into the CPI numbers and the Fed minutes play out tomorrow.